Welcome to the Depth Dive. Today we're cutting through the corporate jargon and diving headfirst into your stack of sources, specifically FedEx's latest 10K.
Mm,
Our mission is really to extract the crucial insights about this logistics giant fast, giving you a shortcut to truly understand where they're heading.
absolutely. This deep dive should illuminate FedEx's, well, profound strategic shifts,
Hmm.
break down its recent financial performance, and explore the major initiatives and, frankly, formidable challenges shaping its future. We'll look at the why behind their bold moves, how they aim to impact the business's efficiency, and what it all truly means for its long-term trajectory in, a rapidly changing global economy.
Okay, so right away, a major theme jumps out. This ambitious idea of one FedEx. Now, this isn't just an organizational church shuffle, is it? It sounds like a fundamental reimagining of how they compete. Historically, these divisions often operated quite independently, sometimes maybe even competing internally. What's the deeper implication here, like for market agility or customer experience that we might not see just on the surface?
Well, what's fascinating here is precisely that foundational internal restructuring. As of June 1st, 2024, FedEx Express, FedEx Ground, and FedEx Services have officially merged into a single entity, Federal Express Corporation. And this is explicitly designed to improve efficiency, reduce costs, and allow teams to operate with greater speed and focus. The implication is a leaner, more agile enterprise, one capable of responding more swiftly to market demands and customer needs, really moving away from those previously fragmented operations.
Right. So bringing previously separate parts under one roof for better synergy makes sense. And this ties into a massive overarching program called Drive, correct?
Exactly. Drive is presented as this comprehensive program to, well, dramatically improve long-term profitability and adapt to changing market conditions. It's kind of a framework to see beyond their current state and explore new possibilities. They've already achieved their target of $1.8 billion in structural cost out in fiscal year 2024.
$1.8 billion dollars already. Okay.
Yep, and they're firmly on track to hit an ambitious $4 billion in savings for fiscal year 2025 compared to the fiscal year 2023 baseline. So this isn't just some one-off project. It's really evolving into a foundational way of working, a rigor that allows them to consistently execute at a high level.
That $4 billion dollars in savings, I mean, that's not just a number. It represents a major strategic pivot for a company of FedEx's scale, doesn't it? What does this magnitude of savings tell us about the competitive pressures in logistics? And how might it force other players to adapt?
That's a really key question. How are they achieving such significant cost reductions? Well, key initiatives under D-Drive include network rationalization,
Hmm.
which involves things like structural flight takedowns and route optimization, along with improvements in hub sort efficiency over at FedEx Express. And then for ground operations, they're seeing benefits from increasing line haul efficiencies and improving dock productivity. It's really about squeezing out every ounce of inefficiency across their vast network.
Squeezing out inefficiency, I like that.
And a critical component of this is Network 2.0. That's a multi-year effort to fundamentally improve how FedEx picks up, transports, and delivers packages in the U.S. and Canada. This involves consolidating the legacy FedEx ground operations into the Federal Express surface operations. They've already done this in over 50 U.S. locations.
Over 50 already.
Yeah, and a phased transition in Canada began back in April 2024. The strategy is to use both employee couriers and contracted service providers, kind of adopting a market-by-market approach in the U.S. surface operations. Imagine trying to rewire a live electrical grid while keeping all the lights on. That's sort of the scale of Network 2.0. It's reinventing the entire circulatory system of a global giant.
Wow, that's a great analogy. It sounds like a massive undertaking then, from air to ground, consolidating and optimizing every single step. You also mentioned Tricolor earlier. Does this relate to their international air strategy? What's its main goal?
Yes, exactly. Tricolor is a core component of D-Drive, specifically aimed at, let's say, radically redesigning the Federal Express International Air Network to improve efficiency and asset utilization. This is particularly crucial as their service mix shifts more towards deferred services, the less time-sensitive stuff. So they're retiming a portion of their owned aircraft fleet to build density and decongest hubs, connecting those global surface networks more effectively. It's really about leveraging their existing assets in smarter ways to match evolving customer demand.
Okay, leveraging assets smarter. Got it. Now, to truly grasp the ambition behind One FedEx, it probably helps to understand the massive structure they're actually consolidating. Historically, FedEx was built on these distinct pillars, each a giant in its own right. Can you maybe remind us how those previous structures operated? Because even though they're merging, their core functions are still vital, right?
Certainly. Historically, you had FedEx Express, which is the world's largest express transportation company. They offer a wide range of U.S. domestic and international time-definite services. Then there was FedEx Ground, a leading North American provider for small package ground delivery. FedEx Freight handled the less-than-truckload, or LTL, freight-heavier shipments, mostly for businesses. And FedEx Services provided the sales, marketing, IT backbone, that sort of thing, with its costs allocated to the other operating segments. So Federal Express is now essentially the new umbrella for express, ground, and services. The whole idea is to make these functions operate seamlessly rather than as separate silos.
Right, breaking down the silos. And what about those more specialized segments like FedEx Custom Critical or FedEx Office? Where do they fit into this new unified structure?
Good question. FedEx Custom Critical, which provides those expedited, time-specific freight services across North America, that's going to be included in the FedEx Freight segment starting in fiscal year 2025. FedEx Office continues to operate its network of, approximately 2,000 customer-facing stores, providing convenient printing and shipping solutions. This includes things like ship-and-go kiosks for self-service and FedEx Consolidated Returns, where you can just drop off items without a box or label at a FedEx Office location. And those drop-off locations extend to nearly 17,000 Walgreens, Dollar General, and Albertsons stores. It really showcases their vast physical presence and commitment to convenience beyond just traditional shipping.
17,000 drop-off points. That's vast, all right. And speaking of vast, their technology and data solutions seem to be a huge focus too, especially with this transformation. What makes their approach here truly innovative?
Yeah, this is where it gets really interesting and truly elevates their strategy, I think. Their founder's vision that the information about a package is as important as the delivery of the package itself. That still drives their strategy today. So FedEx DataWorks is leveraging data and technology, including AI and machine learning, to enhance operational efficiency and create entirely new opportunities. They're not just collecting data, they're actively using it to redefine their processes.
Using the data, not just collecting it. Key difference.
Absolutely. We see this with developments like FDX. That's a fully integrated, data-driven commerce platform they launched in January 2024. It's designed to connect the entire customer journey, from the initial order right through to final delivery. They're also enhancing healthcare services with predictive capabilities for critical shipments, helping ensure temperature-sensitive medications arrive safely. They're even using AI to improve tracking accuracy on FedEx.com. And tools like SenseAware Mobile provide real-time updates on critical shipments, tracking everything from location to temperature in over 130 countries. FedEx SenseAware ID offers even more precision tracking. It really showcases a deep and evolving commitment to digital intelligence complementing, and in some cases, fundamentally reshaping their physical network.
Okay, so all these strategic moves, the cost-cutting efforts, it's ultimately aimed at the bottom line, right? So what did the numbers actually tell us? How did FedEx perform in fiscal year 2024 amidst all this transformation and, well, the broader market conditions?
Right, let's connect this to the bigger picture. Despite a challenging economic environment, their operating income actually improved in fiscal year 2024. It reached $5.559 billion, which is up from $4.912 billion in fiscal year 2023.
An improvement, okay, despite the headwinds.
Exactly. And this significant improvement was largely driven by the vigorous execution of their D-Drive-E program initiatives and a continued focus on revenue quality, basically prioritizing profitable shipments over just sheer volume. However, this positive impact was partially offset by, reduced demand and lower fuel surcharges, which were a direct result of those challenging macroeconomic conditions. So internal efficiencies definitely made a powerful difference in what was a tough year.
So internal improvements helped mitigate things, but external factors still posed significant headwinds. What about total revenue and expenses for the year? What insights can we glean from those figures?
Well, total revenue for fiscal year 2024 was $87.693 billion. That's a decrease from $90.155 billion in fiscal year 2023. And that decline directly reflects the impact of that reduced demand for their services. It kind of signals a critical inflection point in the broader logistics market, maybe even a post-e-commerce boom recalibration across the industry.
A recalibration, interesting way to put it.
Yeah. And on the expense side, total operating expenses decreased to $82.134 billion in fiscal year 2024, which indicates their deep commitment to cost control. A key driver of that expense reduction was fuel expense. It decreased significantly by 20% for FedEx Express in fiscal year 2024, primarily due to lower fuel prices and just fewer shipments. Salaries and employee benefits also saw a slight decrease. This reflects lower staffing levels and increased productivity, though it was partially offset by higher wage rates and variable incentive compensation. It's also worth noting they incurred business optimization costs of $582 million in FY24, up from $273 million in FY23 as part of that DRIVE program. So that's an investment in future efficiency.
Right, spending money to save money down the line. Now, you mentioned non-cash adjustments impacting net income. For a lot of listeners, these paper gains or losses can be a bit confusing, even though they hit the reported bottom line. Could you maybe unpack what those are?
Absolutely. Net income for fiscal year 2024 was $4.331 billion. Now, this figure includes a pre-tax non-cash mark-to-market, or MTM, gain of $561 million related to their retirement plans. Think of it like a paper gain on their pension investments. It's primarily driven by higher interest rates affecting the valuation of their future liabilities rather than, a direct cash inflow.
So not actual cash coming in the door.
Correct. They also recognized $157 million in asset impairment charges in fiscal year 2024. This was largely from the decision to permanently retire certain aircraft and related engines, highlighting those ongoing fleet modernization efforts.
Okay, and what about cash flow? How liquid is the company given all these changes, and what does their capital expenditure tell us about their investment strategy?
Cash provided by operating activities decreased slightly by $2.5 billion in fiscal year 2024, down to $8.312 billion. This was mainly due to working capital changes, particularly an increase in accounts receivable, though it was partially offset by an increase in accrued incentive compensation and a lower net income when you exclude those non-cash items we just talked about. Capital expenditures for fiscal year 2024 were $5.176 billion. That's a decrease from $6.174 billion in fiscal year 2023. So they're continuing to manage and optimize capital allocation in response to the economic slowdown. They are investing, but selectively and strategically, clearly prioritizing efficiency.
Investing selectively. Got it. Now, for shareholders, beyond the operational improvements, what are they doing to directly return value? Because ultimately, that's what many investors are looking for, isn't it?
Oh, absolutely. They have a clear and consistent focus on enhancing stockholder returns. They're continuing with significant share repurchase programs. In fiscal year 2024, they repurchased 9.8 million shares for a total of $2.5 billion. That was at an average price of $255.34 per share.
$2.5 billion in buybacks.
Yeah, and this aggressive buyback activity had a benefit of $0.34 per diluted share in fiscal year 2024, so it shows a direct impact on shareholder value. Plus, a new $5 billion stock repurchase program was authorized back in March 2024. As of mid-July 2024, approximately $4.1 billion remained available under that program. They also executed a $1 billion accelerated share repurchase agreement in June 2024, which is expected to wrap up by the end of the first quarter of fiscal year 2025. All this indicates a really robust commitment to returning capital to shareholders by reducing the number of outstanding shares.
Okay, serious buybacks. And what about dividends? Are they maintaining their payout to investors amidst all this change?
They are. The board declared a quarterly cash dividend of $1.38 per share in June 2024, signaling continued confidence in their financial health. And in terms of pension plans, while no contributions are technically required for their U.S. pension plan in fiscal year 2025 because it's fully funded under ERISA rules, they still expect to make voluntary contributions of $800 million.
Voluntary contributions, even when not required.
Exactly. And that kind of financial stability and commitment to voluntary contributions can be very reassuring to investors. It really demonstrates a robust financial position, even amidst this profound transformation they're undergoing.
Definitely sends a signal. Okay, looking ahead then, what are the major challenges and uncertainties FedEx is navigating? Because even with ambitious plans like D-Drive, the global landscape is, well, constantly shifting.
Yeah, that's the key question now. What's on the horizon? The company itself acknowledges the pervasive uncertainty, a slowing global economy, ongoing inflation, persistent geopolitical conflicts like those in Russia, Ukraine, and the Middle East. These factors directly affect global trade growth, supply chains, fuel prices, the whole nine yards. It makes the outlook for fiscal year 2025 inherently less certain. They explicitly state they expect inflation and high interest rates to continue to negatively affect results in FY25, and they foresee a further shift towards slower, less costly deferred services as customers get more cost-conscious. So it's about managing expectations while aggressively pursuing those efficiencies.
Right. So external macroeconomic pressures remain a significant headwind. But what about internal or operational risks? Especially with such a massive restructuring underway, aren't these kinds of integrations often fraught with challenges?
Oh, you're absolutely right to point that out. The internal risks are substantial. The One FedEx consolidation and the D-Drive transformation, while designed for efficiency, present significant integration risks. There's simply no guarantee these businesses can be fully integrated as planned. This could potentially lead to higher costs than expected, maybe less savings than projected, customer or employee loss, even litigation.
Yeah, losing focus too.
Exactly. The attention of senior management can also be significantly diverted during such a massive transition, impacting day-to-day operations and maybe even innovation elsewhere. Another critical area is labor. Their business is incredibly labor-intensive. Attracting and retaining talent, especially part-time workers where turnover was, get this, a staggering 195% in fiscal year 2024. That's a significant challenge.
Well, 195% turnover. Wow.
Yeah. And they also face risks from ongoing union negotiations with their pilots and potential changes in labor laws, which could disrupt operations. For instance, this recent consolidation could lead to challenges to the Railway Labor Act, or RLA jurisdiction for Federal Express employees. That could potentially shift their union negotiation rules and strike protections to be more like rail and airline industries, rather than general labor laws. That could have wide-ranging implications.
That's a complex legal wrinkle. What about the other legal challenges mentioned in the report? I noticed a particularly striking one that could have broader implications.
Yes, that certainly stands out. FedEx Ground is defending ongoing lawsuits, alleging it should be treated as an employer or joint employer of drivers. That could fundamentally redefine their entire operating model if it goes against them. And more recently, back in May 2021, FedEx Services was named in a lawsuit where a jury initially awarded a plaintiff $365 million in punitive damages
$365 million.
and $1 million in compensatory damages for retaliation claims. Now, this was significantly reduced on appeal in February 2024. The punitive damages were vacated entirely, and the emotional distress award was cut to $250,000 based on FedEx Services' good faith efforts. However, the plaintiffs petitioned the U.S. Supreme Court for review in June 2024, so it's still an ongoing legal matter that underscores the complexities they face. There's also a negligence lawsuit against FedEx Ground related to an alleged kidnapping and murder by a service provider's driver with potential for additional material loss. So these all represent ongoing legal complexities that require significant resources and attention.
That's definitely a lot to contend with on the legal front, and I saw mentions of their ambitious environmental goals as well, particularly the push for carbon neutrality. What are the practical challenges and risks there? Seems like a huge mountain to climb.
Indeed. FedEx has a very ambitious goal: achieve carbon neutrality by 2040 across its global operations, with a $2 billion initial investment. This includes aggressive vehicle electrification, transitioning to sustainable energy, carbon sequestration, the works. However, the practical risks are significant. Think about the availability and cost of alternative fuel vehicles at scale, the immense challenge of building out global electrical charging infrastructure for a massive fleet like theirs, and just the ability to scale new technologies effectively. They even noted that their goal for 50% of owned Federal Express pickup and delivery fleet purchases being electric by 2025 might not be achieved, partly due to the Network 2.0 changes. It really highlights the real-world complexities.
So even their own plans can impact other goals.
Exactly. And failure to achieve these ambitious environmental goals could certainly damage their reputation and stakeholder relationships, impacting future business.
Okay, so wrapping this up, what does this all mean for you, the listener, looking at FedEx's future?
Well, I think you're witnessing a company in the midst of a really profound self-imposed transformation. Moving from that complex, multi-segment structure to a more unified, hopefully more agile operation, they're clearly leveraging digital intelligence to enhance their long-standing physical network, and they're aiming for massive cost savings through programs like D-Drive. Yet they operate in a highly dynamic and often unpredictable global economy. They're facing substantial external pressures, complex internal integration challenges, all while working to meet those ambitious environmental goals.
Yeah, it's a compelling picture, isn't it? A company trying to really reimagine itself for the next 50 years, balancing radical innovation with core business execution.
Precisely. Their ability to deliver on these ambitious efficiency targets while navigating global volatility and those significant legal and labor challenges, that will be absolutely key to their long-term success and sustainability.
Definitely one to watch. Okay, a final thought for you to mull over. As companies like FedEx strive for carbon neutrality and adopt these increasingly integrated digital solutions, how might their efforts reshape the very nature of global commerce and the logistics industry over the next decade? What innovations do you think are truly next for a company trying to be both a physical and digital backbone of global trade?